Have you ever looked at the stock market charts and felt a sense of disconnect? A feeling that the soaring numbers on your screen don't quite match the reality on the ground? You're not alone. Today, we're exploring the critical factors that suggest we might not just be in a bull market, but trapped in one of the most significant investment bubbles of the 21st century. Factor 1. The twin engines of liquidity. First, let's talk about the fuel. For over a decade, central banks have engaged in unprecedented monetary expansion, a global race to print money. In the last few years, this was supercharged by historic fiscal stimulus. This combination has flooded the financial system with trillions of dollars, all searching for a home. And a lot of it has found its way into the stock market, pushing asset prices far beyond their traditional valuations. We're on steroids now, but steroids aren't good for the long run. The question is, what happens when the engines run out of fuel? Factor 2. The AI gold rush. There's no doubt that artificial intelligence will revolutionize our world. We're expecting massive leaps in productivity, perhaps as early as 2030. This promise is driving an incredible rally in tech stocks. But separating the revolutionary promise from the speculative mania is where it gets dangerous. Accurately predicting the full impact of AI over the next 5 years is very difficult. And in reality, it could turn out to be quite wild. This isn't the dot-com bubble. The spoils of the AI revolution will likely be concentrated among a handful of dominant players. As AI disrupts labor markets, governments will likely seek to heavily tax the winners to fund social programs. The upside for investors might be far more complicated than the current hype suggests. Factor 3. Unshakable faith in the Fed put. An entire generation of investors has been conditioned by one simple rule. The Fed will always be there to save them. As of 2025, over 60% of American adults have money in the stock market, meaning a crash is not just a financial event, it's a political crisis. The pressure to print more money during a downturn will probably be immense, because a falling market drags the real economy down with it. But for the first time in decades, inflation is the ghost at the feast. The Fed will probably print money again, but the question is when. This time, the rescue cavalry might wait until after the battle is already lost. Don't be surprised if the bailout only comes after a 50% market decline near an S&P 500 level of 3,000, and even then, a V-shaped recovery is anything but guaranteed. Factor 4. The market is priced for perfection. Let's talk numbers. Right now, the market isn't just optimistic, it's priced for absolute perfection. With the S&P 500 hovering around 6,300, key metrics are flashing red. The Shiller PE ratio is over 37, far above its historical average. The PE ratio is historically elevated at around 29. The price to expected sales is 3.2, while the dividend yield is near historic lows. This pricing leaves zero room for error. Yet we face a minefield of risks. Unstable trade policies, a fragile real estate sector, soaring global debt, rising credit defaults, and explosive geopolitics. The market is priced for a perfect landing on a runway that's on fire. Factor 5. The trend is a friend until the very end. Human psychology is the ultimate market accelerant, exaggerating both greed and fear. Right now, we're in a powerful greed cycle, fueled by a decade-long trend where every dip was a buying opportunity. This self-fulfilling prophecy, where a rising market creates a wealth effect that boosts the economy and thus the market further, feels unstoppable. But this cycle has a dark twin: fear. Remember 2000, 2008, 2020? When the headlines turned apocalyptic, legions of investors capitulated at the absolute worst time, selling everything just to stop the pain. That's the other side of this psychological coin, and the higher we climb, the more brutal the potential fall can be. Factor 6. Everyone's a genius in a bull market. It has never been so easy to pull a phone out of your pocket and place a trade, and many people dream of financial freedom. Social media has become the new Wall Street, but there's a dark side. It's dominated by young, popular, and charismatic influencers who are masters of marketing. We grew up on fairy tales, and we still love to hear them. It's no surprise that influencers selling a dream of guaranteed riches get more followers than seasoned professionals who preach caution and patience. But some of these new social media gurus should be teaching what they truly know: social media marketing, not risk management. This creates a dangerous feedback loop of hype, fueling the market even higher. Factor 7. The legends are warning us. When the people who have mastered the game start sounding the alarm, it pays to listen. Ray Dalio warns of a paradigm shift from overwhelming US debt and political conflict. Jim Rogers predicts the worst crash of our lifetimes, and is buying real assets like silver and farmland. Jeremy Grantham calls this an AI-driven super bubble on par with the 2000 mania. JP Morgan's Marko Kolanovic insists that investors are dangerously complacent about economic risks. Michael Burry of The Big Short is actively shorting the tech sector, betting against the hype. Meanwhile, Warren Buffett is sitting on a record cash pile and corporate insiders are selling their shares at a record pace. Now these legends have been wrong before, but when this many masters of the universe are saying the same thing, ignoring them is a bold and potentially catastrophic bet. Factor 8. How high can crazy go? So what's my personal take? We've reached a level of market insanity that could, paradoxically, get even more intense in the short term. Let me be crystal clear, this is not investment advice, and I am not risking my capital on the long side of this trade. However, history shows that every great bubble deserves a final euphoric round of FOMO. While timing the market is a fool's game, there are rare moments when the odds stack decisively in one direction. I'm patiently waiting for that moment, the final parabolic surge of the indices, as my signal to play the downside. But is it possible that this market could defy gravity and continue climbing for an extended period, even without a major bear market? After more than 2 decades in this game, my experience forces me to consider the impossible. So the crazy answer is yes. There are still powerful variables in play. For example, a generous fiscal policy could theoretically continue for several more years. It's an unhealthy strategy, but it's possible. Furthermore, with the US burdened by historic debt, there is always the option to reduce it through inflation, and history gives us clear examples where stocks have climbed a wall of worry during high inflation, especially within specific resilient sectors. But I have no desire to invent more narratives to justify endless growth. I firmly believe this time is not all that different and that we are inflating a historic stock market bubble, so my strategy is simple. 50% of my entire portfolio is now in cash. To me, the certainty of that boring few percent in a savings account is infinitely smarter than playing a high-stakes game of musical chairs, hoping you're not the one left standing when the music stops. What are your thoughts? Are we in a bubble, or is this time finally different? If you like this content, give it a thumbs up. If you don't, subscribe anyway and stay as happy as possible.